Welcome everyone, and thank you all for joining this special event with our partner Saugatuck Financial, where we'll be talking about Biden versus Trump and what each candidate's tax policy would mean for you. Firstly, I hope you and your loved ones are keeping well during what has and continues to be an incredibly challenging time for so many people. I'm Juliet Scott-Croxford, CEO at Worth Media and your moderator for today, and I'm delighted to be joined by our special guest Justin Charise, CFP and founding partner of Saugatuck Financial, and Robert Finkel, partner in charge and co-chair of New York City Moritt Hock Hamroff. Hi speakers.
Thanks for having us.
Thanks for joining us today. Our intention at Worth is to create conversations that help inspire and inform you, our community, many of whom are investors and entrepreneurs and business leaders who want to be informed on matters relating to business innovation, finance and wealth, as well as leave a positive impact on the world and help to create a more inclusive and equal economy for the benefit of everyone. And we call that Worth Beyond Wealth. So we hope you enjoy this session and find it valuable. With the US presidential election looming, it's hard to avoid it at the moment, and the economy in the midst of one of the worst downturns in history, both President Donald Trump and former Vice President Joe Biden have proposed early drafts of their tax policies meant to address the nation's pandemic-fueled fiscal challenges. While Trump wants to extend a 2017 tax overhaul for individuals, Biden has proposed a rollback of tax cuts and a tax hike for those making more than $400,000 a year. But what will these policies actually mean for American citizens should they go into effect? We're delighted to be joined by special guests today, Justin Charise, founding partner of Saugatuck Financial, and Robert Finkel of Moritt Hock Hamroff, to share their perspectives on each candidate's proposed tax plans and the real world implications that the 2020 election could have on your finances. So many of you will be familiar with this format by now. A few housekeeping rules. This is a conversation. It is a discussion. We really welcome questions, comments, and engagement from you. Please do use the chat function at the bottom of your screen and type that to all panelists and all attendees. Share your questions, share your comments, and we can unmute you so you can ask the questions directly to the speaker, or if you prefer to remain anonymous, that's totally fine, and we can weave it into the conversation as we go. So let's get started about Biden versus Trump and what each candidate's tax policy would mean for you. Firstly, a personal check-in. Justin, how are you? How's the last sort of 8 months been? And I'd love to hear briefly a bit about your background, and also a bit about obviously your role, but also share, if you will, some information on Saugatuck Financial.
Yeah, absolutely. Thank you so much, Juliet. First of all, thank you for having us again. In terms of how I'm doing, I feel blessed to be here today, grateful for the year that we're having as a practice and the health of myself and my family and friends. So feeling very grateful today. In terms of my background in Saugatuck Financial, I grew up in Connecticut, went to West Point for undergrad, spent 5 years in the Army, went on to business school, and I joined Goldman Sachs working in their investment banking division in New York City, and decided to leave Goldman on my own about 12 years ago to become a certified financial planner and founding partner of Saugatuck Financial. And our practice is providing comprehensive planning to our clients. So it's wealth management, tax strategies, insurance planning, retirement planning, income distribution strategies for our clients in retirement, estate planning. Really depends on the client's situation, where our firm could add the most value, and that often evolves for our clients over time as their situations change. We use Northwestern Mutual as our broker dealer, and we have an open architecture on both the investment and insurance sides, in the sense that we have access to almost every fund in the industry on the investment side and almost every insurance carrier on the insurance side. And within Northwestern Mutual, our practice is ranked amongst the top 10 advisory practices in the country. So it's a little background. That's
brilliant. Thank you, Justin. And Absolutely. Bob, how are you doing personally and professionally? Please do share a bit about your background and the company that you work for.
Thank you very much, Juliet, for asking, and thank you for including me today. I'm pleased to say that everybody by me is healthy, safe, comfortable, and in good spirit. So that, of course, is the most important. On the professional side, the business has been remarkably good. Interestingly, I'm a tax lawyer. I've been practicing for 35 years. I started my practice with IRS Chief Counsel's Office litigating tax cases, and then transitioned over to private practice when my wife was pregnant with our second child, and we decided that we didn't want to take turns eating anymore. So it was a good move for me. I'm now practicing in New York City at Moritt Hock. It's a 90-lawyer New York-based firm in general practice. My role is largely supporting the M&A transactional practice. I support the estate group quite a bit, and we do an awful lot of work with entertainers, musicians, and athletes. And my primary role there is supporting their endorsement contracts and other investments. And all of that adds up to a pretty good place for me right now.
Brilliant. Thank you, Bob. So let's jump straight in. I think you can sort of see in the media and even in the debate this week that the tax implications of this election are a topic of debate. Just in personal income tax rates, and not surprisingly, one of the topics that voters are tending to be most interested in, and understanding each presidential candidate's stance on. Can you just walk us through any important components of Biden's personal income tax plan, and what does that mean?
Absolutely. So you mentioned this $400,000 threshold earlier, and that's a very key threshold in Biden's tax proposal. And below that $400,000 of income, you're okay. I wouldn't expect to see an increase in tax. Above that, there are a few changes under Biden's tax proposal that you should be aware of. One of which is the top marginal tax bracket, which is currently $518,000 for single filers. $622,000 is where it starts for married couples filing jointly. Biden's tax proposal has that dropping all the way down to $400,000. Second component is the top marginal tax bracket right now is 37%. Biden's proposal has that increasing back up to the 39.6% it was before the Tax Cuts and Jobs Act of 2017. And then the third component of it, which is a pretty big one, is there's something called a Social Security payroll tax, which right now is applicable to the first $137,700 of income. And Biden's tax proposal has that also being applicable to all income above $400,000, which creates what's often referred to as this donut hole, where between $137,700 of income and $400,000, you won't have that 12.4% Social Security payroll tax, but for the first $137,700, you will, like you do now. And then above $400,000 of income, you would have that 12.4% Social Security payroll tax, which is split evenly between the employer and employee.
And they're pretty significant increases if you're earning over $400,000 a year. Is there anything a taxpayer earning that amount can do to plan for this type of personal tax income increase?
Yeah, it's a great question, and I'll caveat some ideas that I'll throw out there with, I wouldn't recommend doing anything at this point until we're through the election. Nobody knows exactly how the election is going to turn out. And even if Biden is elected, unless Democrats take over control of Senate, I think it's going to be very challenging for him to pass a lot of these proposed tax increases. Another element to consider is the coronavirus. Nobody knows exactly how that's going to play out, but if we're in a fragile economy come 2021, I think the likelihood of tax increases being passed, even if Biden is elected and Democrats gain control of Senate. I think the likelihood comes down if we're in a fragile economy because of the coronavirus come 2021 as well. With that said, some considerations if Biden is elected and if Democrats take over control of Senate include the idea of accelerating income. If you're a business owner, try to accelerate as much income as you can into 2020, with the thought process being that income would be subject to a lower tax rate in 2020 than it might be in 2021. And similarly, you may want to consider doing something that is opposite of what is generally done. Generally, business owners are trying to accelerate expenses to get the expenses in before the end of the calendar year. You may want to delay those expenses until 2021 with the same mindset. If your tax bracket or your tax rate is higher in 2021, having higher business expenses will ultimately reduce your taxable income in 2021. So that'll overall put you in a better situation. Another consideration is Roth conversions. So if you've been contemplating the idea of a Roth conversion and holding off on it, if you're going to execute it, it may be more advantageous for you to execute it before year-end 2020 rather than waiting to 2021 and potentially having that Roth conversion subject to a significantly higher tax rate.
Just to explain for those that are on this session that wouldn't know what that means, what does that mean?
Yeah, absolutely. So, with an IRA, there's two types of IRAs. You have a traditional IRA and a Roth IRA. Traditional IRAs operate from a tax perspective similar to a 401k in that it's pre-tax dollars that are invested. The investment grows tax deferred, and on the tail end, everything that you pull out subject to ordinary income tax. Roth IRAs are quite the opposite. It's after tax dollars, so you have no tax benefit day one, grows tax deferred, and then the tax benefits down the road when you take withdrawals, it's entirely tax-free. Well, the IRS, a handful of years ago, as part of their effort to collect tax revenue, started to allow people to execute what are called Roth conversions, where you take a portion or all of an IRA and you convert it to a Roth IRA. Now, when you do that, you have to pay ordinary income tax on whatever portion you're converting. It's treated as income that year from a tax perspective, but then you end up with a Roth IRA that grows tax deferred and you can access tax-free down the road.
That's great, thank you. And I just wanted to say a very warm welcome to the Worth community and those that have just joined this session. We're here talking about Biden versus Trump and what each candidate's tax policy would mean for you. And we have special guest Justin Charise from Saugatuck Financial and Bob Finkel from Moritt Hock Hamroff with us, sharing their perspectives on the outcome of this. Bob, what about Trump's tax plan? Will it simply involve a continuation of current tax laws, or do you think it will change?
The expectation is that it'll be more of the same. He will undoubtedly look to extend many of the tax incentives which benefit wealthier and high-income taxpayers by pushing out sunset provisions, which would eliminate the benefits in 2026. I think you will see that he will try to expand the 20% deduction on pass-throughs. If you can, I think he'll continue with the reduced corporate rates. He hasn't put a whole lot of meat on the bones here. He did specifically say that he wants to expand the Opportunity Zone program, which of course permits investors to defer and possibly eliminate tax on existing investments. In fact, that's a strategy that taxpayers might want to consider, even if the Biden plan passes, if this continues, because of the increased rates proposed by Biden on long-term capital gains. He has proposed a Made in America tax credit, although it hasn't really quite explained how that's going to work. Biden has a similar sentiment expressed in his plan as well. But essentially what we're talking about is a roll forward of the 2017 Tax Act, into the next term. He, of course, needs the consent of Congress in order to do these things. We don't know how the election is going to plan out, work out, but if he has a Republican Congress, he's likely to be able to get what he wants.
And Justin, can you speak to some of the impacts that Biden's tax plan might have on investors specifically?
Absolutely, absolutely. I think there's a handful, but I think the two biggest are probably his proposal for taxpayers earning more than $1 million to have their long-term capital gains subject to ordinary income tax rather than the much lower long-term capital gains tax rate. So that would roughly double what a taxpayer would pay when realizing unrealized gains that are long-term. Another part involves a 26% flat tax credit for retirement plan contributions. And that 26% is not solidified. He hasn't specified that, but that's the overwhelming consensus around what the tax credit might end up being, is at 26%. And the idea there is, rather than the contributions into a 401k, as an example, being able to reduce your taxable income, he wants to offer a flat tax credit equal to 26% of the contribution. And what that effectively ends up doing is creating a scenario where 401k contributions are going to become more attractive for taxpayers in lower tax brackets, lower than 26%, and less attractive for taxpayers who are in tax brackets above the 26%. So to give you an example of what I mean by that, let's say a taxpayer who is in a 12% marginal tax bracket contributes $10,000 into a 401k under the Biden plan. $10,000 contributed into the 401k. That $10,000 is still taxable as ordinary income. There's no longer a tax deduction for 401k contributions. And that individual receives a tax credit of 26% of that $10,000. So they end up with a $2,600 tax credit, and they've only paid $1,200 in taxes, 12% of the 10,000. So they're actually making money by contributing into the 401k. On the flip side, if you look at that same $10,000 contribution into a 401k under the Biden tax proposal being made by someone in the highest tax bracket, 39.6% under the Biden tax proposal, they still have that $10,000 subject to the 39.6% top marginal tax bracket because it's not deductible under his plan, and instead they get this 26% tax credit. Well, now they're getting $2,600 as a tax credit, but they have to pay $3,960, the 39.6% of the 10,000 in taxes. So it's actually costing them more than $1,300 to contribute that $10,000 into the 401k in taxes. So what it ends up creating is a double taxation for individuals in the higher tax brackets, where their contributions into their 401k doesn't receive really a full tax deduction. They're still paying some taxes when you net out the tax credit. And then down the road, when they take withdrawals in retirement, those are subject to ordinary income tax.
Bob?
Yeah, and it also has a complication on the state, because of course, once you've taken a deduction and turned it into a credit, that you don't have the benefit of reducing adjusted gross income on the state level. And so you have an additional state tax that you didn't have before. So you're not getting the benefit of that deduction on the state level. So that's a double whammy for high income wage earners.
So a question for both of you, and Justin, maybe let's start with you, but what are some of the planning strategies that might be worth considering and deploying here if you have invested assets, if you're approaching retirement? What are some of the things that people should be thinking about?
Yeah. So, obviously roughly doubling the current long-term capital gains tax rate to have long-term capital gains subject to ordinary income tax for earners above the $1 million level is significant. So one of the things that we're doing as a practice now is taking a look at our advisory accounts, and obviously we wouldn't execute any of this yet, but we like to come up with a plan beforehand that we have ready to execute if it makes sense to do so. And one of the strategies we've been thinking through is the idea of reducing exposure to high dividend paying stocks in taxable accounts, and reducing exposure to funds that tend to have higher capital gains distributions in taxable accounts, and maybe shifting more of that exposure to our clients' qualified accounts, their IRAs, which are tax sheltered instead. So that's, one example of what we're looking at on the wealth management side to manage through some of these potential tax law changes. And then on the side of the 26% tax credit for retirement plan contributions, as I mentioned earlier, it's going to become more attractive for those individuals in lower tax brackets to contribute because of what I've walked through already, and less attractive for individuals in the higher tax brackets. One thought process is if our clients have the ability to contribute to Roth 401ks, now that may be a better option if they're in the higher tax brackets. And another strategy that could become relevant for clients in the higher tax brackets is permanent cash value life insurance, whether variable universal life or whole life. Those products offer you tax deferred growth and various strategies to be able to access that cash value tax free. So, my expectation is if that type of tax law were to come in effect, that those types of strategies are going to become more and more relevant for our clients than they are already.
That's interesting. And a lot of the Worth community are philanthropists and charitably inclined. They want to use their wealth for good and to leave a positive impact, not just on themselves and their family, but on the community, on the world around them. How might each candidate's tax plans impact charitable giving strategies?
Yeah, really good question. When we look at what's happened under the Trump administration, one of the biggest things he did was pass the Tax Cuts and Jobs Act of 2017. And as part of that, the standard deduction was roughly doubled. So right now it's, I think, $24,800 is a standard deduction if you're married filing jointly. And then he changed how itemized deductions are treated. So each year when you file taxes, you can either take the standard deduction, call it $24,800 if you're married filing jointly, or you itemize your deductions. And if your itemized deductions are higher than standard deduction, then you're going to itemize your deductions. When we look at itemized deductions, there are 4 primary itemized deductions: state and city income tax and property tax. You have mortgage interest, and you have charitable donations. So he put a cap on your ability to deduct what's often referred to as SALT, state and city tax, as well as property tax, at $10,000. So that left 2 primary itemized deductions: your mortgage interest and your charitable donations. So we have a lot of clients that say give $10,000 a year to charity. And let's say they're renting, to keep it simple. They have no mortgage interest, or renting, or they paid off their mortgage. Now they're not really getting any benefit from that $10,000 annual gift to charity, because they're just going to take the standard $24,800 deduction. However, one strategy that we've implemented with numerous clients is setting up a donor advised fund. And the idea there is, rather than gifting $10,000 a year to charity directly, let's gift maybe $50,000 into a donor advised fund this year, and we'll itemize our deductions this year. And then going forward over the next handful of years, we'll make charitable donations directly from the donor advised fund to the charities. And in those years, we'll take the standard deduction. So that was under the Tax Cuts and Jobs Act. Now, what Biden wants to do is different. He wants to get rid of the $10,000 cap on salt, but he also wants to limit the tax benefit from making itemized deductions to 28%. And he also wants to bring back the phase out of itemized deductions. And he wants that phase out to begin at $400,000. And the phase out's 3% of income above $400,000. So to walk through a scenario there, let's assume that the taxpayer is earning above the $400,000 threshold. If they give $100,000 to charity under the Biden plan, they would only be able to deduct $28,000 of that. So they're in the top tax bracket, 39.6%, but they could only deduct 28% of it. So they end up still paying $11,600 in taxes on that $100,000 charitable donation that they made, not even bothering factoring in the 3% phase out of itemized deductions. So, long story short is a planning strategy for clients who are charitably inclined is to set up a donor advised fund before the year end 2020 and contribute to it this year. And, hopefully net, there's a lot of moving pieces here, but the tax benefit from that would likely be greater this year under the Tax Cuts and Jobs Act than it might be under the Biden tax proposal.
But wait until the outcome of the election.
Exactly. Great point, Juliet. Yeah. Absolutely wait to the outcome of the election. And again, if Biden's elected, that doesn't mean these tax proposals would move forward. I really think that the control of the Senate would have to shift from Republicans to Democrats. And on top of that, for Biden's tax plan to come to fruition in the nearer term, I think the situation with coronavirus would have to stabilize and the economic conditions of 2021 be a lot stronger than what we've seen in 2020.
There's so many intricacies of this. This is why you need a financial advisor in your life. Just a reminder for the community listening, please do share any comments or questions you've got for speakers in the Q&A or in the chat box. Bob, slight change in topic. Estate planning is often a hot topic for wealthy families. Is Biden proposing any material challenges to current estate tax laws?
Well, there are a couple of things that he's proposing that are significant. The 2017 Tax Act, as many of our listeners know, increased the exemption, the estate and gift exemption, to $11 million. Biden's proposing to cut that back to 5.5, and that's a significant change. What we have been advising our clients to do is to consider making gifts now rather than waiting to some later date when the Biden or some other administration reduces that $11 million window. And there may be some additional value in thinking about doing it right now. The COVID crisis has affected the value of private companies. For sure, their performance and unlike the publicly traded securities, I think may justify a discount, which could be helpful in that regard. If you are thinking about doing something by the end of the year, and many of my clients are, irrespective of the outcome of the election, frankly, you want to get to think about lining up an appraiser if one is needed to value the assets, because they'll be busy. Another component is the loss of the step up in basis. When a decedent dies with an estate holding assets under current law, the tax basis of the assets held in the estate is stepped up to the fair market value as of the date of death. So while there is an estate tax that is paid, if one is applicable, there a later sale of that asset because the built-in gain goes away. Now, what the Biden proposal includes is a provision which says the basis at the time of death will remain the same. Now, that presents a practical challenge because, of course, the beneficiaries receiving these assets have no clue what the tax basis is in the assets that they've just inherited. And as a practical matter, many decedents didn't know and were what the basis was of the assets that they'd held all these years either. And so administering this thing is going to be very, very difficult. By the way, this isn't the first time that this has been done. I think 1976, for a few years, this was done. It was the rule, and was terribly unpopular and was eliminated.
And we've talked a lot about the impact on high income earners. Are there any components to Biden's proposal that would specifically impact on the middle class and also on business owners specifically?
Well, let's just stay with estate tax for a moment. There are many decedents' estates which come nowhere close to being taxable estates for federal purposes, but which have benefited from this step up in basis in assets. And this is gone. This is a big hit across the board. I think one that's going to be very unpopular. The retirement credit that Justin mentioned is going to be a big one for the reasons that he explained. The marginal benefit of a deduction, of course, is greater at the higher tax rates than it is at the lower rates, and so there will be a benefit to this fixed credit for lower income taxpayers, again subject to the state tax offset because there's no deduction there. Manufacturers are going to see a credit for expanding jobs in manufacturing. That will of course be an important benefit. The plan calls for something called new manufacturing communities, and there'll be a 10% Made in America tax credit. Pharma takes a hit, by the way, in this plan.
Pharma.
Pharmaceutical industry. These television ads we see constantly have been in part a product of a tax benefit that they have now. Biden plans to cut back the tax breaks on prescription drug advertisements. I don't know how we're ever going to know what's wrong with ourselves if we don't have these commercials, but we may just be on our own. Businesses with overseas affiliates are going to see increases on tax on foreign profits. Interesting.
Rob, you there?
Yeah, I lost my screen.
Okay.
An interesting point about the Trump tax plan, which created a huge tax incentive to bring back offshore funds held by affiliates, is that those dollars that returned never did what Trump told us he hoped that they would do, which would be an investment in capital and labor here in the States. We brought back $660 billion of cash, which was taxed at as low as 8% as opposed to 35%, and it was part of a $1 billion stock repurchase and dividend program, the likes of which the country hadn't seen in a very long time. So, go ahead.
Question on a couple of the industries that you mentioned, because you mentioned a couple of industries that might be negatively impacted by this, but are there, and a question for either of you, are there any industries that might be impacted positively by Biden's tax plan?
Well, there will be some benefit for manufacturing,
Yeah.
and those incentives, I think, are going to be material. I think, though, that,
what about private equity? What about private equity?
Well, private equity is an interesting one. The carried interest issue has been floating around for a long time, and the carried interest, of course, is the allocation of a portion of gain on the activities of a private equity fund or venture fund to the fund sponsors, really in exchange for the work that they do. And because of partnership tax laws, historically, those allocations were taxable at long-term capital gains rates, 20%, rather than ordinary income at 39.6. The Trump Act included sort of a half-hearted attempt to close that loophole by requiring a special 3-year holding period for certain types of assets, but there was a huge hole in that program for 1231 assets, which include real estate. Hard to know whether Biden will at some point take a hard run at that. But other things that the private equity world has to begin to think about is that to the extent that their investors are individuals, and many are, the increase in tax rate on long-term capital gains presents a challenge, because of course if they are in a $400,000 income bracket, they will be taxed at ordinary income rates. What we are likely to see is more consideration given to installment sales, that is to say tails, payouts over longer periods of time, structuring so that the gain, if possible, doesn't trigger that higher rate. But of course, there's business risk associated with that, and there's opportunity costs to not holding the funds as well, and those will all be in the mix.
I want to make sure we leave enough time for some of the questions that have come in. But before we do, Justin, with $25 trillion of federal debt, as much as people don't like paying higher taxes, is it simply a necessity at this point for this country to help us begin to dig out of the debt?
That's a really good question. Great question, Juliet. It's interesting. On its face value, you would think that an increase in taxes would result in an overall increase in tax revenue, but that's not necessarily the case. If you think about it, if taxes increase, then the consumer has less after-tax dollars in their pocket to spend. It doesn't matter who the taxes are being increased on. Consumer ends up with less after-tax dollars to spend. So now that consumer that may have gone on a vacation, they end up staying at home. And you think of the impact on the various industries in that case, airlines, hotels, restaurants, their demand comes down. And then they don't need as many employees. So unemployment increases and everybody's sitting at home, not spending money. That's a very real scenario when you see tax rates increase materially. On the flip side, if tax rates decrease, now the consumer has more after-tax dollars in their pocket, so they're more inclined to spend. So maybe you hire the landscaper to do that big project you've been wanting to do. And that landscaper is having a great year because everybody's doing projects now. And he goes out and he buys a new car that he's really wanted. And that car salesman, he's having a great year. So he's going to take his family on this big vacation. And, this concept speaks to what's called the velocity of money. And what the velocity of money is how many times a dollar is used to purchase goods or services during a given time period. And if you increase the velocity of money, even if tax rates are lower, your overall tax revenue could be higher. So as an example, let's say taxes were at 60% and they got reduced to 30%. But the velocity of money increased such that the IRS received that 30%, not once on that dollar during the time period, but 4 times. Now they've received $1.20 of tax revenue rather than 60 cents at the higher tax rate. So I think that's a really important concept that's often overlooked. On its face, people think increased taxes, that'll be the answer to start to chip away at this enormous $25 trillion of federal debt. And I'm not making a political statement here in any sense, but I think the best way to chip away at that is really improve the overall health of the economy and increase the overall velocity of money rather than just increasing tax rates. Right. I think that's very, very important. Another thing it doesn't seem to be spoken about very frequently lately, but spending. Everybody seems to be focused on taxes. I've heard very little conversations around spending, and I think that's important too. Is really for the government to get control of spending, not just focus so much on taxes.
I think that Justin is right about the velocity of money. I think the real question is where that velocity occurs. Now, if somebody who is in the top 0.5% saves $500,000 in taxes and gets his lawn cut, that's pretty good. And of course, the gardener gets to spend the money and maybe buy braces for his kids. But he only cuts his lawn once. And if there is some easing at the lower end of the spectrum, you're talking about many, many times numbers of lawns. And this played out, we saw with the dollars that were brought back from Europe. The companies that brought back $640 billion couldn't spend it all or decided not to spend it all. And as a consequence, it didn't have the impact that the Trump administration had planned in terms of creating jobs. So we don't disagree. The velocity of money and the movement of money, the spending, this is all very, very important. But the number of dollars that's spent in the middle class, potentially, because they need to consume it, could be greater and faster than the same dollars in the top 1%.
There's a couple of questions that have come in. One is which is, are there any noteworthy impacts to Biden's plan on first-time home buyers and parents in relation to childcare?
Yeah. And there are. There's a $15,000 credit proposed in the Biden plan for first-time home buyers. It's not just a refundable credit, but it's an accelerated refundable credit, which means you don't have to wait necessarily until you file your tax return to get it. The child care credit, I think, is $2,000 now. It's going to be increased to $3,600 for children 6 years or younger than 6 years, and $3,000 for children older than that. So there are some important benefits at that level.
And timing, would the home buyer credit be applicable to anyone that is a first-time home buyer in this financial year if Biden were to be elected?
I don't know the particulars, but I assume that it is.
Right. And then there's another question from Emily. Are there any tax policies that are being discussed that will benefit the environment and the sustainability? Justin, are you familiar?
Yeah, I don't know the exact details other than from a high level. I know Biden is in favor of continuing tax credits to clean energy, and that's somewhat of an opposite stance of Trump. And again, I don't know the details. I don't know if Bob can speak to them at all, but from a high level.
Bob, any insight into that?
That's my take on it too. That Biden is looking to expand the tax credits for clean energy. That this is wind, this is solar. I think even the biofuels and electric vehicles.
And get rid of the other piece of that is get rid of the tax credits or incentives for fossil fuels is something that Biden would like to do.
And are there any policies that other than that would sort of benefit society for the greater good that have been laid out?
Loaded question.
It wasn't meant to be.
From my perspective, anything that gets Americans working is critically important. The American dream, from my perspective, is waking up, having a job, working hard, earning enough money to feed your family, and going to bed tired. And whatever it is that we can do to create good jobs here in the United States, I think needs to be at the top of our list. I think that's what Biden is focused on with his manufacturing incentives. By the way, he also has an interesting clawback. If a company has taken public value incentives to create a plant here in the States, and then within a short period of time closes it down and moves abroad before the anticipated or promised benefit is realized, that's going to be clawed back. An important step, I think.
How do you see tax policy changing in the long term future? Sort of fast forward post this election, what changes do you think we'll see?
I think it's largely going to be driven by not only who's elected as president, but as mentioned earlier, who controls Senate. Right now, the Republicans control Senate. 35 of the 100 seats are up for election come November. If Democrats take over control of Senate and Biden is elected, my expectation is tax rates would increase. If Trump is elected and Republicans maintain majority control over Senate, I think we'll stay in the current tax environment. Maybe there'll be some additional reductions in tax rates, but I think it'll largely be driven by that. Hopefully in a civil way.
Let's hope so.
Yeah, I think that, look, it depends upon which Republicans turn up next session, because of course the Republicans have a long history of being conservative on spending and being allergic to deficits. And what we've seen in this last few years is an increase in the deficit of 17% in 2018 over 17, and 26% 2019 over 2018. And we now have, as we all know, a federal debt that increased that surpassed $1 trillion in 2019. The Republicans in the days of yore would not tolerate that.
And to close this out, both of you, maybe Bob, you can start. Regardless of who wins the election, what are the bright spots that you see on the horizon? Bob, why don't you go first?
I think that this is a tremendously resilient country. And while I live here in the bubble of New York City, I am very proud to see men and women and children walking the streets, wearing masks, buying groceries, eating at restaurants, and living their lives. We are a strong country based on really important fundamentals, and we will survive this difficulty, I'm sure.
Yeah. And Justin?
I agree with Bob 100%. We're an extremely resilient country, and I look forward to the future and getting back to a situation where the social distancing becomes less of a necessity and we're able to get out there and socialize. And I'm looking forward to being back in the office with my team eventually, who's phenomenal, and they're all working from home and do so in an amazingly productive way. And I feel very blessed, as I mentioned earlier, and grateful to have my health, my family's health, my friends' health, our team's healthy, and we're looking forward to continuing that in 2021 and beyond.
Justin and Bob, thank you so much for such an insightful discussion. And it was great to kind of get the expert view into the candidates' proposed tax plans and the real world implications of the outcome of the election and how that might impact the Worth community's finances. A special thank you again as well to you, Justin, and the team at Saugatuck Financial for being our partner for this programme. And most importantly, thanks to all of you that joined us today and for your great questions. We hope you enjoyed it. We hope you found it interesting. Please do share any feedback with us. We'd love to hear your comments. You can email us at community@worth.com. We will have a piece of content to share in the next week or so, outlining some of the things that we discussed in today's session. We'll also have an edited video which we'll be sharing with the Worth community for those that missed the live session today. Next week on Worth Live, join us on Tuesday 3 p.m. ET for the Voices of Savannah, showcasing the people behind a rising city. On Wednesday at 3 p.m. ET is the next instalment of our Re-Architecting Philanthropy series with venture philanthropy organisation New Profit. And join us on Thursday at 3 p.m. Eastern Time for the next normal series, where we'll be talking about how COVID is impacting mental health with some very special guests. Please register online at worth.com/events for this. Sign up for our newsletters. And in the meantime, be kind to yourself and others. Stay healthy, stay safe, and enjoy the rest of your day and the weekend. Thanks again.
Thank you, Juliet.
Thank you.
Thank you, Juliet.
Thanks, Bob. Thanks, Justin. See you soon.